Imagine a single company that controlled $8 trillion in trade, that owned entire countries, that had its own armies, navies, and currencies, that could declare war, negotiate treaties, and execute foreign leaders. Now imagine that this company invented the stock market, created modern capitalism, and established the business model that every multinational corporation still uses today. This isn't science fiction. This was the Dutch East India Company, the VOC, and for 200 years they were the most powerful economic force on Earth. The numbers are staggering. At its peak, the VOC controlled 50% of all global trade. They employed over 1 million people across 4 continents. Their private navy was larger than most national fleets. Their annual revenues exceeded the GDP of entire European nations. But here's what most people don't know. The VOC didn't just dominate 17th and 18th century commerce. They literally invented the financial systems that control today's global economy. The stock market, created by the VOC in 1602, corporate shares that you can buy and sell, VOC innovation, multinational corporations with shareholders, VOC business model, modern banking, insurance, and international finance, all pioneered by this single Dutch company. They figured out how to raise capital from thousands of investors, spread risk across global operations, and generate returns that made their shareholders the richest people in history. They created the first corporate bonds, the first stock exchange, and the first international investment funds. Amazon controls about 6% of global retail commerce. Apple's market capitalization reached $3 trillion. Google dominates internet search and digital advertising. The VOC controlled more economic power than all of these companies combined. They didn't just participate in global trade. They owned the infrastructure, controlled the shipping routes, and determined which nations could access Asian markets. For 2 centuries, if you wanted spices, silk, tea, porcelain, or precious metals from Asia, you dealt with the VOC or you got nothing. They had monopoly control over trade between Europe and the most valuable markets in the world. But their real innovation wasn't trade. It was creating a business structure that could survive longer than any individual, accumulate capital faster than any government, and expand across continents without losing central coordination. They solved the fundamental problem of early capitalism: how to pool resources from multiple investors, coordinate activities across vast distances, and distribute profits fairly while maintaining operational control. The solution they developed became the template for every major corporation that followed. Microsoft, Walmart, ExxonMobil, Tesla, they all use organizational structures and financial instruments that the VOC pioneered 400 years ago. This is the story of how one Dutch company created modern capitalism, dominated the global economy for 2 centuries, and established the corporate model that rules the world today. It's a story about innovation and greed, genius and brutality, wealth creation and human exploitation on a scale that makes today's corporate scandals look like minor accounting errors. Chapter 1. Corporate Birth. The meeting that would change the world forever took place in a cramped Amsterdam warehouse on March 20, 1602, where 17 Dutch merchants gathered to create something that had never existed before: the world's first multinational corporation. These weren't ordinary traders hoping to make quick profits from exotic imports. They were strategic thinkers who understood that dominating Asian trade required solving fundamental problems that had plagued international commerce for centuries. The challenge was enormous. Portuguese and Spanish empires controlled most existing trade routes to Asia. English competitors were aggressively expanding their operations. Asian markets were thousands of miles away across dangerous seas. Individual trading voyages required massive capital investments with uncertain returns and enormous risks. Most Dutch traders operated as small partnerships that funded single expeditions. If a ship was lost to storms or pirates, the entire investment disappeared. If political conditions changed, trading privileges could be revoked without compensation. If market conditions shifted, traders couldn't adapt quickly because they lacked the capital for alternative strategies. The solution these 17 merchants proposed was revolutionary: create a permanent corporation that could pool investment capital from hundreds of individuals. coordinate multiple simultaneous operations, and maintain continuous presence in Asian markets, regardless of short-term setbacks or political changes. But creating this corporation required innovations in law, finance, and business organization that didn't exist anywhere in the world. The legal challenge was defining corporate personhood, creating an organization that could own property, sign contracts, and operate businesses independently of its individual shareholders or managers. The financial challenge was developing systems for pooling capital from multiple investors, distributing profits fairly, and maintaining investor confidence through years of uncertain returns and operational difficulties. The organizational challenge was coordinating activities across vast distances with primitive communication systems while maintaining central authority over local operations and preventing managers from pursuing their private interests at corporate expense. Jan van Oldenbarnevelt, the Grand Pensionary of Holland, understood that solving these challenges could transform the Dutch Republic from a small European nation into a global economic power. The Dutch had already demonstrated superior capabilities in banking, insurance, and international trade that made Amsterdam the financial center of Northern Europe. But competing effectively with Portuguese, Spanish, and English colonial empires required organizational innovations that could mobilize resources on a scale that individual Dutch merchants couldn't achieve independently. Van Oldenbarnevelt's solution was granting the VOC a charter that combined commercial privileges with governmental authority in ways that created an entirely new form of economic and political organization. The Charter of 1602 granted the VOC monopoly rights to all Dutch trade east of the Cape of Good Hope and west of the Strait of Magellan, essentially giving them exclusive Dutch access to all of Asia, the Indian Ocean, and the Pacific Ocean. But the charter went far beyond normal trading privileges. It granted the VOC authority to build fortifications, maintain armies and navies, negotiate treaties, administer territories, collect taxes, establish courts, and exercise all functions of government within their operational zones. This wasn't just a commercial license. It was a delegation of sovereign authority that made the VOC a state within a state, accountable to Dutch authorities, but autonomous in its operations throughout most of the world. The corporate structure that the Dutch created to manage this authority was even more revolutionary than the governmental powers they granted. The VOC was organized as a joint stock company with shares that could be bought and sold by any investor. Initial capitalization was set at 6.5 million guilders, equivalent to approximately 100 million today, raised through public subscription rather than government funding or private partnerships. Shares were sold in units of 3,000 guilders, but investors could purchase fractional shares or pool their resources to buy full units. This democratized corporate investment in ways that enabled middle-class merchants, artisans, and even servants to participate in international trade that had previously been limited to wealthy nobility or major merchant families. The company was managed by a board of directors elected by shareholders, with operational authority delegated to professional managers who reported to the board rather than pursuing their private interests. Profits were distributed to shareholders through dividends based on their proportional ownership of corporate shares, creating incentives for long-term corporate success rather than short-term extraction of wealth by individual managers. Here's what made this structure revolutionary. It solved the fundamental problems that had prevented large-scale international commerce, while creating new capabilities that enabled economic operations on a previously impossible scale. Individual investors could participate in profitable Asian trade without risking their entire wealth on single voyages. Corporate resources could absorb losses from failed expeditions while continuing operations that generated long-term profits. Professional management could develop expertise and relationships that persisted beyond individual careers or political changes. Most importantly, the corporation could accumulate and reinvest profits in ways that enabled continuous expansion and improvement of operations, rather than simply distributing all returns to investors for immediate consumption. But the VOC's corporate structure also created new problems that revealed fundamental tensions within capitalist organization. Shareholders demanded growing dividends and rising stock prices that pressured management to maximize short-term profits regardless of long-term sustainability or human costs. Professional managers developed interests and perspectives that sometimes conflicted with shareholder priorities, creating agency problems that required constant monitoring and control systems. The corporation's combination of commercial and governmental authority created opportunities for abuse that neither traditional merchant partnerships nor government agencies had possessed. These tensions became apparent almost immediately during the VOC's first decades of operation. Shareholders complained that management was too conservative in their expansion strategies and demanded more aggressive pursuit of profitable opportunities, regardless of risks or ethical considerations. Management complained that shareholder pressure for immediate returns prevented long-term investment in infrastructure and relationships that could generate more sustainable profits. Colonial administrators complained that corporate profit maximization conflicted with effective territorial governance and local economic development. But despite these internal tensions, the VOC's innovative corporate structure enabled them to mobilize resources and coordinate activities on a scale that overwhelmed their competitors and transformed global commerce. Within 10 years of its founding, the VOC had established permanent trading posts throughout Asia, built the world's largest merchant fleet, and generated returns for shareholders that exceeded any previous commercial enterprise. Their success demonstrated that the corporate business model could solve fundamental problems of international commerce while generating enormous wealth for investors. But it also established patterns of corporate behavior that prioritized shareholder returns over social responsibility and legitimate concerns about the concentration of economic power in institutions that weren't directly accountable to democratic governance. Understanding how the VOC's corporate innovations enabled their commercial success while creating new forms of economic exploitation provides crucial insights into contemporary debates about corporate power and responsibility. The same structural features that made the VOC the most successful commercial enterprise in history also enabled them to become one of the most destructive and exploitative organizations in human history. The tension between corporate efficiency and social responsibility that emerged during the VOC's early years continues to challenge modern capitalism and democratic governance today. The question isn't whether corporate organization is beneficial. It clearly enables economic coordination and innovation that wouldn't be possible under alternative systems. The question is how corporate power can be structured and regulated to serve broader social interests rather than just shareholder enrichment. The VOC's story provides both inspiration and warning for contemporary efforts to balance corporate freedom with democratic accountability and social responsibility. But first, we need to understand how their corporate innovations enabled them to create the world's first stock market and establish the financial systems that still govern global capitalism today. Chapter 2. Stock Innovation. On August 17, 1602, something unprecedented happened in human history. Ordinary people could buy ownership stakes in a business venture they would never personally manage, in territories they would never visit, trading goods they might never see. The Amsterdam Stock Exchange opened for trading in VOC shares, creating the world's first public stock market and establishing financial mechanisms that would eventually enable capitalism to become the dominant global economic system. This wasn't just a new way to raise capital. It was a fundamental reimagining of how economic value could be created, transferred, and accumulated across time and space. Before the VOC, investment in long-distance trade required personal participation or direct relationships with expedition organizers. Investors either traveled with their goods or entrusted them to specific merchants whose success or failure determined their returns. The VOC created something completely different: tradable ownership stakes in a permanent corporation whose value derived from future earnings rather than current assets. VOC shares represented claims on profits from trading activities that hadn't happened yet, in territories that might not be controlled yet, using strategies that hadn't been developed yet. Investors were buying expectations rather than tangible goods or specific services. This abstraction of economic value from immediate physical reality enabled entirely new forms of wealth creation and financial speculation that continue characterizing modern capitalism. The Amsterdam Stock Exchange became a laboratory for financial innovation that produced techniques and institutions that modern investors would recognize immediately. Daily trading sessions with official opening and closing times. Professional brokers who facilitated transactions between buyers and sellers. Market makers who maintained liquidity by continuously offering to buy or sell shares. Written contracts that standardized terms and reduced transaction costs. But perhaps most importantly, the exchange developed systems for price discovery that reflected collective assessments of corporate value based on available information about business prospects, management competence, and economic conditions. This created feedback mechanisms between corporate performance and investor behavior that had never existed before. When the VOC announced successful trading expeditions, share prices rose as investors bid for ownership stakes in future profits. When expeditions failed or political conditions deteriorated, share prices fell as investors sought to limit their losses. These price movements provided information about corporate performance and investor sentiment that enabled more sophisticated analysis of business prospects and more efficient allocation of capital across competing opportunities. But the stock market also created entirely new forms of economic manipulation and financial speculation that had no relationship to productive business activity. Within months of opening, the Amsterdam Stock Exchange was attracting investors who had no interest in the VOC's trading activities and were purely speculating on short-term price movements based on rumors, political developments, or technical analysis of trading patterns. Joseph de la Vega's Confusión de Confusiones, published in 1688, described speculative techniques that modern options traders would immediately understand: bulls and bears, puts and calls, margin trading, and short-selling strategies designed to profit from price movements regardless of underlying business fundamentals. Sophisticated investors were using borrowed money to amplify their returns, betting against stock prices through short sales, and creating complex derivative instruments that transferred risks and rewards in ways that obscured the relationship between financial markets and real economic activity. This speculative activity served useful economic functions by providing liquidity and price discovery mechanisms, but it also created opportunities for manipulation and abuse that threatened the stability of both corporate finance and broader economic systems. The most significant innovation was the development of credit instruments that enabled investors to leverage their capital and amplify their returns through borrowing. Dutch banks began offering loans secured by stock holdings, enabling investors to purchase more shares than they could afford with their own resources. This increased demand for stocks while creating new risks if share prices fell below loan values. Insurance companies developed policies that protected investors against stock market losses, creating markets for financial risk that operated independently of underlying business risks. Investment partnerships pooled resources from multiple investors to pursue coordinated trading strategies that individual investors couldn't execute independently. These financial innovations increased the efficiency and sophistication of capital markets while creating new forms of systemic risk that could threaten economic stability if speculative bubbles collapsed or financial institutions failed. The VOC's management had to adapt to operating in an environment where their stock price was as important as their trading profits, where investor expectations affected their access to capital, and where financial market conditions influenced their strategic options. This created incentives for corporate behavior that prioritized short-term stock price performance over long-term business development, leading to management decisions that maximized immediate investor returns rather than sustainable competitive advantages. The company began providing regular financial reports to shareholders, developing investor relations strategies, and modifying their business strategies to meet market expectations rather than purely operational considerations. But the stock market also provided the VOC with unprecedented access to capital that enabled them to pursue expansion strategies that wouldn't have been possible under traditional financing methods. When the company needed additional capital for new expeditions or territorial expansion, they could issue new shares to existing shareholders or attract new investors through public offerings. When they wanted to acquire competing companies or develop new business lines, they could use their stock as currency for transactions that didn't require cash payments. When they needed to attract and retain talented managers, they could offer stock options that aligned management incentives with shareholder interests. These capabilities enabled the VOC to grow faster and more sustainably than competitors who relied on traditional partnerships or government financing. The success of VOC stock trading also encouraged other companies to adopt similar corporate structures and seek public listings on the Amsterdam Stock Exchange. The Dutch West India Company, founded in 1621, copied the VOC model for operations in the Americas and West Africa. Various manufacturing, shipping, and financial companies began offering public shares to fund their expansion and development. Amsterdam became the center of international finance, as investors from throughout Europe sought access to Dutch capital markets and trading opportunities. But the proliferation of joint stock companies and active stock trading also created new challenges for economic regulation and financial stability. Market manipulation became a serious problem as wealthy individuals and organized groups used their resources to drive stock prices up or down for speculative profits that had no relationship to business fundamentals. Information asymmetries created opportunities for insider trading as corporate managers, government officials, and well-connected investors profited from non-public information about business developments or policy changes. Speculative bubbles periodically developed when investor enthusiasm drove stock prices far above reasonable valuations based on business prospects, leading to inevitable crashes that destroyed investor wealth and disrupted economic activity. The Dutch government struggled to develop regulatory frameworks that could prevent the most serious abuses while preserving the economic benefits of active capital markets and corporate innovation. The tension between financial innovation and economic stability that emerged in 17th century Amsterdam continues to challenge modern financial regulation and monetary policy. Contemporary debates about high-frequency trading, derivative instruments, and systemic risk reflect similar concerns about ensuring that financial markets serve productive economic purposes rather than enabling purely speculative activity that threatens broader economic stability. The VOC's experience demonstrates both the enormous economic benefits that sophisticated capital markets can provide and the serious risks that financial innovation can create when it outpaces regulatory oversight and institutional safeguards. Understanding how the world's first stock market developed and evolved provides crucial insights into how modern financial systems operate and what reforms might be necessary to ensure that financial innovation serves broader economic development rather than just enabling wealth concentration and speculative manipulation. But the VOC's financial innovations were only one aspect of their revolutionary business model. Their real competitive advantage came from using corporate finance to fund military conquest and monopoly control over the most valuable trade routes in the world. The next phase of their story involves how they used shareholder capital to wage private wars against established empires and indigenous nations throughout Asia, establishing the precedent for corporate imperialism that would dominate global politics for the next 3 centuries. Chapter 3. Spice Wars. The VOC's shareholders weren't just investing in peaceful trade, they were funding a private war machine designed to eliminate every competitor and establish total monopoly control over the most valuable commodities on Earth. The spice trade wasn't merely lucrative, it was the equivalent of controlling oil, semiconductors, and rare earth metals combined in today's economy. Pepper, nutmeg, cloves, cinnamon, and mace were essential for food preservation, medicine, and luxury consumption throughout Europe, but they grew only in specific tropical regions controlled by various Asian kingdoms and trading networks. European demand for spices generated profit margins that seem impossible by modern standards. Nutmeg purchased for the equivalent of $1 in the Banda Islands could sell for $300 in Amsterdam markets, a 30,000% markup that made successful spice traders wealthier than European nobility. But accessing these profits required overcoming established trading systems that had operated for centuries without European participation. Portuguese traders had established fortified trading posts throughout the Indian Ocean during the early 1500s, using superior naval technology and aggressive military tactics to insert themselves into existing Asian commercial networks. Spanish colonial authorities controlled access to Asian markets through their territorial possessions in the Philippines and their dominance over trans-Pacific shipping routes. English and French trading companies were rapidly expanding their Asian operations and competing aggressively for access to the most profitable spice-producing regions. Most importantly, Asian kingdoms and trading organizations weren't passive suppliers waiting for European customers. They were sophisticated commercial entities with their own political interests, military capabilities, and economic strategies that often conflicted with European objectives. The VOC's approach to this complex competitive environment was systematically eliminating every alternative source of spices through coordinated military and economic warfare that treated commerce as an extension of national conflict. Their first target was the Banda Islands, a small archipelago in present-day Indonesia that produced the world's entire supply of nutmeg and mace. The Bandanese people had maintained trading relationships with Asian and Islamic merchants for centuries, selling their spices through commercial networks that connected Southeast Asia to India, the Middle East and Europe without requiring territorial control or political subordination. But the VOC wasn't interested in participating in existing trading systems. They wanted to own them. In 1609, the VOC signed a treaty with Bandanese leaders that granted them exclusive access to nutmeg exports in exchange for protection against Portuguese and Spanish interference. The treaty appeared to create mutually beneficial commercial relationships that respected Bandanese sovereignty, while providing the VOC with reliable spice supplies. But the VOC's interpretation of exclusive access proved different from what the Bandanese had understood. When Bandanese traders continued selling nutmeg to traditional Asian customers, VOC officials declared them in violation of their exclusive agreement and demanded compensation for stolen profits. When Bandanese leaders attempted to renegotiate the treaty terms, VOC administrators accused them of bad faith and threatened military action to enforce the original agreement. When some Bandanese communities refused to accept VOC control over their traditional trading activities, the company declared them in rebellion and began military operations to impose their authority by force. The conflict escalated rapidly because the VOC possessed military technologies and organizational capabilities that the Bandanese couldn't match. VOC ships carried cannons that could destroy traditional fortifications from distances that made retaliation impossible. VOC soldiers used coordinated infantry tactics and firearms that overwhelmed traditional warfare methods. VOC administrators could coordinate military operations across multiple islands while maintaining supply lines and reinforcements from their bases in Java and the Netherlands. But the decisive factor was the VOC's willingness to use extreme violence to eliminate any possibility of future resistance or competitive challenge. In 1621, under the direction of Governor-General Jan Pieterszoon Cohen, VOC forces began what can only be described as genocidal warfare designed to depopulate the Banda Islands and replace the indigenous population with Dutch colonists and enslaved laborers. Cohen's strategy was eliminating all existing political and economic relationships that might threaten VOC monopoly control while creating new social arrangements that would maximize company profits from nutmeg cultivation. VOC soldiers systematically destroyed Bandanese villages, executed community leaders, and enslaved or expelled the surviving population. The company imported Dutch colonists and enslaved Javanese laborers to operate nutmeg plantations under direct VOC management. Within 5 years, the indigenous population of the Banda Islands had been reduced from approximately 15,000 to fewer than 1,000 survivors. Traditional political institutions, economic systems, and cultural practices were completely eliminated and replaced with VOC administrative control. This wasn't just commercial competition, it was corporate colonialism that used shareholder capital to fund territorial conquest and population replacement for private profit maximization. The Banda conquest became a template for VOC expansion throughout Southeast Asia. In the Moluccas, Spice Islands, The company used similar tactics to eliminate Portuguese influence and establish monopoly control over clove production. They signed exclusive trading agreements with local rulers, then used military force to prevent any alternative commercial relationships that might threaten their market dominance. In Java, they systematically undermined the Mataram Sultanate by supporting rival claimants to the throne, then used the resulting civil wars to expand their territorial control and extract favorable commercial concessions from whichever faction needed their military support. In Ceylon, Sri Lanka, they displaced Portuguese colonial authorities and imposed VOC control over cinnamon cultivation through a combination of naval warfare, diplomatic manipulation, and strategic alliances with local political factions. The pattern was consistent. The VOC would identify regions that produced valuable spices, negotiate commercial agreements that appeared mutually beneficial, then use their military superiority to eliminate any competitive threats and establish total monopoly control over production and distribution. But the company's military expansion wasn't just about eliminating competitors. It was about creating integrated economic systems that maximized shareholder profits while minimizing operational costs. VOC territorial control enabled them to impose labor systems that reduced production costs below what competitive markets would have required. They could force local populations to work on spice plantations for wages that were below subsistence levels, supplemented by subsistence agriculture that workers performed on their own time without company compensation. They could prevent workers from pursuing alternative economic opportunities that might increase labor costs or reduce the supply of plantation workers. They could eliminate local merchants and trading networks that had previously captured portions of the profits from spice production and distribution. Most importantly, they could control the supply of spices reaching European markets to maintain artificially high prices that wouldn't be possible under competitive conditions. The VOC's monopoly control over nutmeg production enabled them to restrict supply to levels that kept European prices at 10,000 to 20,000% above production costs. They maintained warehouses full of nutmeg that they systematically destroyed to prevent oversupply that might reduce prices. This market manipulation generated enormous profits for VOC shareholders while creating artificial scarcity of essential goods that affected food preservation and medical treatment throughout Europe. But the company's monopolistic practices also created strategic vulnerabilities that competitors could exploit if they developed alternative supply sources or technological innovations that reduced European dependence on Asian spices. English and French competitors were attempting to cultivate spice plants in their own colonial territories to break VOC monopoly control. Scientific advances in food preservation were reducing European dependence on spices for basic dietary needs. Alternative trade routes were enabling some competitors to access Asian markets without confronting VOC military control. The VOC responded to these challenges by intensifying their military expansion and monopolistic practices rather than developing more sustainable competitive strategies. They increased their military expenditures to patrol larger territories and prevent any alternative sources of spice supplies from reaching European markets. They expanded their territorial control to include potential cultivation areas that competitors might use for spice production. But this strategy required constantly increasing military expenditures and territorial administration costs that began to consume growing portions of the company's revenues. By the 1670s, the VOC was spending more on military operations than they earned from trade, forcing them to extract increasing tribute and taxation from their territorial possessions to maintain their competitive position. This created a vicious cycle where territorial expansion required military expenditures that required increased extraction from colonized populations, leading to resistance and rebellion that required even more military expenditures to suppress. The human costs of VOC monopoly control extended far beyond the initial conquest and colonization of spice-producing regions. Colonial labor systems created conditions of extreme exploitation that killed hundreds of thousands of workers through overwork, malnutrition, and disease. Monopolistic price controls caused economic disruptions that created famines and social chaos throughout regions under VOC influence. Military operations to suppress resistance and eliminate competitors involved systematic violence against civilian populations that violated even the limited humanitarian norms of the 17th and 18th centuries. But for VOC shareholders, these human costs were externalities that didn't appear in their financial statements or affect their dividend payments. The corporate structure that enabled the VOC to mobilize capital and coordinate global operations also insulated investors from direct responsibility for the violence and exploitation that generated their profits. Shareholders received regular dividend payments without detailed information about how those profits were generated. They could benefit financially from VOC success while maintaining plausible ignorance about the human costs of corporate operations. This separation between financial benefits and moral responsibility became a characteristic feature of modern capitalism that continues affecting corporate behavior and investor psychology today. Understanding how the VOC used corporate finance to fund private warfare and monopolistic exploitation provides crucial insights into the relationship between corporate power and human rights that remains relevant for contemporary debates about multinational corporate responsibility and democratic oversight of business activities. The next phase of their expansion involved building the world's first truly global corporation with operations on every inhabited continent and influence over international politics that exceeded many national governments. Chapter 4. Global Empire. By 1650, the VOC had achieved something no organization in human history had accomplished before. They operated as a single coordinated enterprise across 4 continents with unified management, shared financial systems, and integrated strategic planning that spanned the entire globe. This wasn't just international trade. It was the creation of a parallel world system that operated according to corporate objectives rather than national interests or local community needs. The scale of VOC operations was unprecedented. They maintained over 300 trading posts, fortresses, and administrative centers from Cape Town to Nagasaki. They employed more than 70,000 Europeans and 200,000 Asians in activities ranging from international commerce to territorial administration. Their fleet included over 1,000 ocean-going vessels that carried goods, passengers, and military forces across trade routes that connected Europe, Africa, Asia, and the Americas. Their annual shipping volume exceeded that of most European nations. But the VOC's real innovation wasn't the scale of their operations. It was creating organizational systems that could maintain central coordination and strategic coherence across distances and time delays that would have made unified management impossible using traditional business methods. The key breakthrough was developing what modern business theorists would recognize as matrix management structures that combined geographic and functional specialization with hierarchical authority systems that maintained ultimate control in Amsterdam headquarters. The company was organized into separate chambers, kamers, in different Dutch cities that handled specific geographic regions and functional responsibilities. The Amsterdam Chamber controlled operations in Java and the eastern Indonesian archipelago. The Zeeland Chamber managed trade with India and Ceylon. The Rotterdam Chamber handled African operations and the Cape Colony. Each chamber operated with substantial autonomy in managing its assigned territories and business lines, but all reported to the Central Board of Directors, here in 17th, that coordinated overall corporate strategy and financial management from Amsterdam. This structure enabled the VOC to adapt to local conditions and opportunities while maintaining strategic coherence and preventing regional operations from pursuing conflicting objectives that would undermine overall corporate performance. Regional governors and factors could respond quickly to changing political conditions, market opportunities, or competitive threats without waiting for instructions from Amsterdam. But they operated within strategic frameworks and resource constraints determined by central management based on global corporate objectives. The communication systems that connected these far-flung operations were marvels of early modern logistics and information management. The VOC maintained regular shipping schedules that carried correspondence, financial reports, strategic directives, and personnel transfers between Amsterdam and major Asian trading centers. Ships departing Amsterdam carried instructions and resources for operations throughout Asia. Return voyages brought detailed reports about local conditions, financial performance, and strategic recommendations. But the company couldn't rely solely on official communication channels to coordinate global operations across months or years of travel time between different regions. They developed standardized operating procedures, financial reporting systems, and decision-making protocols that enabled local managers to respond appropriately to routine situations without specific instructions from central management. They created training programs for colonial administrators that ensured consistent implementation of corporate policies across different cultural and political environments. They established audit and oversight systems that could detect and correct local deviations from corporate standards, even when central management couldn't provide continuous supervision. Most importantly, they developed incentive systems that aligned local management interests with global corporate objectives through profit-sharing arrangements, promotional opportunities, and performance evaluation criteria that rewarded behavior that served overall corporate success rather than just regional performance. The financial systems that supported these global operations were equally sophisticated and innovative. The VOC maintained integrated accounting systems that tracked revenues, expenses, assets, and liabilities across all global operations, using standardized procedures that enabled meaningful performance comparisons between different regions and business lines. They developed internal banking systems that could transfer funds between different operations without physical transportation of gold or silver across dangerous ocean routes. Credits earned from profitable operations in one region could finance expansion or emergency support in other regions. They created insurance systems that pooled risks across global operations so that losses in one region wouldn't threaten the viability of the entire corporation. Successful operations could cross-subsidize less profitable but strategically important activities. They maintained reserve funds and credit arrangements that could provide emergency financing for unexpected military conflicts, natural disasters, or economic disruptions that threatened specific regional operations. But perhaps most innovative was their development of what modern corporations would recognize as transfer pricing systems that enabled them to optimize their global tax burden and profit allocation across different political jurisdictions. The VOC could manipulate the prices they charged for goods and services transferred between their own operations in different territories to minimize their overall tax obligations while maximizing the profits reported in jurisdictions with favorable tax treatment. They could time their purchases and sales to take advantage of seasonal price variations, currency fluctuations, and political changes that affected profitability in different markets. They could coordinate their operations across multiple regions to create artificial scarcities or surpluses that enabled them to manipulate prices in ways that served overall corporate interests rather than local supply and demand conditions. These capabilities enabled the VOC to generate profits and accumulate power on a scale that threatened the sovereignty of established political authorities throughout their operational territories. By the 1660s, the VOC controlled more economic resources than most European governments. Their annual revenues exceeded those of France or England. Their military forces were larger and better equipped than many national armies. Their political influence extended throughout Asia, as local rulers competed for VOC commercial relationships and military support. Their economic decisions affected prices, employment, and living standards for millions of people across 4 continents. But this unprecedented concentration of private power also created strategic vulnerabilities and political opposition that would eventually threaten the company's long-term sustainability. European governments became concerned that the VOC's quasi-sovereign status and enormous resources might threaten their own authority and national interests. The English government supported the expansion of the East India Company, partly to counterbalance VOC influence and ensure that English national interests weren't completely subordinated to Dutch corporate objectives. The French government created competing colonial enterprises and provided military support for anti-Dutch coalitions in Europe and Asia. Even the Dutch government became ambivalent about the VOC's independence and global influence, as company objectives sometimes conflicted with broader Dutch diplomatic and military priorities. Asian governments and peoples subjected to VOC control began organizing resistance movements that challenged company authority and threatened their territorial possessions and commercial operations. The Javanese leadership gradually unified opposition to Dutch control through complex diplomatic and military campaigns that exploited divisions within VOC administration and built coalitions with other European competitors. Indian rulers began coordinating with English and French traders to create alternative commercial relationships that could reduce their dependence on Dutch trade and military support. Chinese authorities limited VOC access to their markets and supported alternative trading networks that reduced Dutch influence over regional commerce. These political challenges were compounded by economic changes that reduced the profitability of the VOC's traditional business model. European demand for Asian spices was declining as improvements in food preservation technology reduced the necessity of spice imports for basic dietary needs. Competition from other European companies and alternative supply sources was reducing the VOC's ability to maintain monopolistic pricing and profit margins. The costs of maintaining global military and administrative operations were growing faster than revenues from commercial activities, creating financial pressures that forced the company to extract increasing tribute from their territorial possessions. But rather than adapting their business model to changing economic and political conditions, the VOC attempted to maintain their global dominance through strategies that intensified the political and economic pressures that were threatening their long-term viability. They increased their military expenditures and expanded their territorial control to prevent competitors from accessing alternative sources of valuable commodities. They intensified their exploitation of colonized territories to generate the revenues needed to fund their expanding military and administrative operations. They became more dependent on monopolistic price manipulation and market control rather than competitive efficiency and customer service. These strategies generated short-term profits for shareholders while creating long-term strategic vulnerabilities that would eventually destroy the company's competitive position and political viability. The VOC's experience demonstrates both the enormous possibilities and the fundamental limitations of private corporate power in global affairs. Their innovative business model enabled them to mobilize resources and coordinate activities on a scale that created unprecedented economic opportunities and generated enormous wealth for investors and employees. But their pursuit of monopolistic control and short-term profit maximization also created political opposition and economic inefficiencies that undermined their long-term sustainability and competitive advantage. Understanding how the VOC built and managed the world's first global corporation provides crucial insights into the possibilities and challenges of multinational business enterprise that remain relevant for contemporary debates about corporate globalization and democratic governance. But the next phase of their story involves examining the specific mechanisms they use to control international trade and manipulate global markets in ways that generated the equivalent of $8 trillion in modern economic value. Chapter 5. Trading Networks. To understand how the VOC controlled $8 trillion worth of trade, you need to understand that they didn't just participate in global commerce. They owned the infrastructure, set the rules, and determined which goods could move where and at what prices. This wasn't a free market, with multiple competitors serving consumer needs. This was a controlled economy designed to extract maximum value from global trade while directing those profits to Dutch shareholders. The scale of VOC control becomes clear when you examine the specific trade routes and commodities they dominated at the height of their power in the mid-1600s. The spice trade alone generated revenues equivalent to over $2 trillion annually in today's purchasing power. European demand for pepper, nutmeg, cloves, cinnamon, and mace was essentially infinite at profitable price levels, and the VOC controlled the production and distribution of these essential commodities throughout most of Europe. But spices were only the beginning of their commercial empire. The VOC controlled the majority of Asian silk exports to Europe, managing supply chains that connected Chinese silk producers to European luxury markets through trading posts in Taiwan, Java, and India. They monopolized the trade in Japanese silver that provided essential currency for Asian commercial relationships, while supplying European monetary systems. They dominated the porcelain trade that brought Chinese ceramics to European consumers, while controlling the supply of European silver that Chinese producers demanded as payment. They managed the tea trade that would eventually become essential to European daily life, while maintaining exclusive relationships with Chinese tea gardens and export merchants. The cotton textile trade connecting Indian producers to global markets operated largely through VOC commercial networks that determined prices, quality standards, and distribution patterns for products that clothed millions of people throughout Europe, Africa, and the Americas. They controlled the precious stone trade that brought diamonds, rubies, and other gems from Asian mines to European luxury markets. They managed the trade in medicinal plants and exotic materials that supplied European pharmaceutical and manufacturing industries. But beyond these specific commodities, the VOC controlled the physical and financial infrastructure that made long-distance trade possible. They owned the largest merchant fleet in the world, with over 1,000 ocean-going vessels specifically designed for different types of cargo and different trade routes. Their shipyards in Amsterdam and Asian bases could build, repair, and maintain vessels using the latest maritime technology while employing thousands of skilled craftsmen. They controlled the most strategic ports and harbors throughout the Indian Ocean, providing secure harbors, warehouse facilities, fresh water, and supplies for the thousands of ships that carried goods between Europe and Asia each year. Their fortified trading posts provided security, commercial infrastructure, and administrative services that made complex international transactions possible in regions where no stable governmental authority existed or where local authorities couldn't provide adequate protection for valuable cargo. Most importantly, they controlled the information networks that enabled sophisticated international commerce. The VOC maintained the most reliable and comprehensive intelligence system in the world, with agents throughout Asia who provided detailed reports about political conditions, economic developments, weather patterns, and competitive activities that affected international trade. They published and distributed maps, navigation guides, and commercial information that other traders depended on for successful operations. Their control over essential navigation and market information gave them decisive advantages over competitors who lacked comparable intelligence resources. They maintained communication networks that connected Amsterdam with trading posts throughout Asia through regular shipping schedules and courier systems that enabled coordinated strategic planning across global operations. But the VOC's real competitive advantage was their financial control over international commerce. They operated the most sophisticated credit and currency exchange systems in the world, enabling complex transactions that involved multiple currencies, delayed payments, and risk management across different political jurisdictions. European merchants who wanted to purchase Asian goods typically couldn't finance these transactions without access to VOC credit facilities. The company could provide letters of credit, currency conversion, and payment guarantees that made international commerce possible for smaller traders, while maintaining control over the terms and conditions of those transactions. Asian producers who wanted to export their goods to European markets depended on VOC commercial relationships for access to European customers and credit systems. The company's control over European distribution networks enabled them to determine which Asian producers could access profitable export opportunities. This financial control created network effects that reinforced the VOC's market dominance, even in regions where they didn't exercise direct territorial control. Merchants throughout Asia competed for VOC commercial relationships because company contracts provided access to the most profitable markets and the most reliable payment systems. European consumers received goods through VOC distribution networks because alternative suppliers couldn't provide comparable selection, quality, or pricing. The cumulative result was a global trading system where the VOC captured value at every stage of production and distribution, while other participants received only the minimum returns necessary to maintain their cooperation. Asian producers received prices for their goods that were typically 10 to 20% of the final European retail prices. European consumers paid prices that were 500–1,000% above Asian production costs. The VOC captured most of the value difference through their control over transportation, financing, marketing, and distribution. To quantify this in modern terms, the VOC's annual revenues during their peak period represented approximately 4–5% of total global economic output. For comparison, Amazon's annual revenues represent about 0.4% of global GDP. The VOC controlled 10 times more of the global economy than today's largest corporations. But maintaining this control required constant innovation and adaptation to changing competitive and technological conditions. Other European companies were attempting to break VOC monopolies by developing alternative supply sources, establishing competing trade routes, and providing better terms for Asian producers and European consumers. Technological improvements in navigation, shipbuilding, and communication were reducing the advantages that the VOC had gained through earlier innovations and larger-scale operations. Political changes in Asia were challenging the company's territorial control and exclusive trading relationships, as local rulers developed more sophisticated understanding of international commerce and greater bargaining power with European traders. The VOC responded to these challenges by intensifying their control over global trading networks through strategies that prioritized short-term profit maximization over long-term competitive sustainability. They increased their use of military force to eliminate competitors and maintain exclusive control over the most profitable trade routes and commodity sources. They expanded their territorial conquests to prevent alternative supply sources from developing and to control larger portions of the value chains that generated profits from international trade. They manipulated market conditions through artificial scarcity creation, price fixing, and supply chain control that maintained high profit margins regardless of changing supply and demand fundamentals. These strategies were enormously successful in generating short-term profits for shareholders and maintaining the company's dominant market position. VOC dividends during their peak period averaged 20–25% annually, returns that would be considered spectacular by modern investment standards. The company's stock price appreciation generated enormous capital gains for long-term investors, but these monopolistic practices also created economic inefficiencies and political opposition that undermined the long-term sustainability of the VOC's business model. Artificially high prices for essential commodities created economic hardships for European consumers and reduced the overall growth of markets that could have generated larger long-term profits under more competitive conditions. Excessive extraction from Asian producers reduced their incentives to increase production and improve quality, limiting the growth of supply sources that could have supported expanding global markets. Military expenditures required to maintain monopolistic control consumed increasing portions of the company's revenues, creating financial pressures that forced even more intensive extraction from controlled territories and trading relationships. Political opposition from competitors, colonial subjects, and even allied governments created strategic vulnerabilities that threatened the company's long-term viability regardless of their short-term financial success. The VOC's experience illustrates both the enormous economic benefits that efficient global trading networks can provide and the serious problems that arise when those networks are controlled by monopolistic enterprises that prioritize private profit maximization over broader economic development. Modern multinational corporations operate in more competitive and regulated environments that prevent the kind of comprehensive market control that the VOC achieved, but they face similar tensions between short-term profit maximization and long-term sustainable development. Understanding how the VOC built and managed global trading networks provides insights into contemporary debates about international trade, corporate responsibility, and the regulation of multinational business enterprises that remain relevant for policy discussions about globalization and economic development. But the VOC's commercial success was only possible because they possessed military capabilities that enabled them to enforce their economic control through violence against any individuals, communities, or governments that challenged their market dominance. The next chapter examines how they built the world's first global corporate military and used it to wage private wars that established the precedent for corporate imperialism that would dominate international relations for the next 3 centuries. Chapter 6. Military Corporation. The VOC wasn't just a trading company that happened to have some armed guards. They were a military organization that used corporate finance to build private armies larger than most European national forces. At their peak, the VOC maintained military forces of over 40,000 European soldiers and 100,000 local auxiliaries, equipped with the latest military technology and organized according to professional standards that exceeded most contemporary governmental armies. This wasn't defensive security to protect their trading operations. This was offensive military power designed to conquer territories, eliminate competitors, and impose corporate control over populations that had never consented to Dutch authority. Their military budget consumed 60% of corporate revenues during periods of active expansion, making them as much a warfare enterprise as a commercial organization. But what made the VOC's military power unprecedented wasn't its size. It was the integration of corporate finance, professional military organization, and strategic coordination that enabled them to project force globally while maintaining unified command and control from Amsterdam headquarters. The company's military structure combined European military innovations with local recruitment and adaptation that created hybrid forces capable of operating effectively across different geographical and cultural environments. VOC European troops were professional soldiers recruited specifically for Asian service, trained in the latest infantry tactics, and equipped with superior firearms and artillery that gave them decisive advantages over most Asian military forces. But European troops were expensive to recruit, transport, and maintain, and they suffered high mortality rates from tropical diseases that made purely European military forces economically unsustainable for large-scale operations. The VOC's solution was creating mixed military units that combined European leadership and advanced weapons technology with locally recruited soldiers who understood regional conditions and could operate effectively in Asian climates and terrain. These hybrid forces proved far more effective than purely European armies, while costing substantially less to maintain than comparable forces composed entirely of European professionals. Indonesian, Indian, and African recruits provided local knowledge, language skills, and cultural understanding that European officers lacked. They could operate in climates and terrain that incapacitated European soldiers. They understood local political dynamics and military traditions that European tacticians couldn't anticipate. But European officers provided professional military training, advanced weapons technology, and strategic coordination that enabled these diverse forces to operate as disciplined units rather than irregular militias. The result was military organizations that were more adaptable and effective than comparable European forces, while maintaining the technological and organizational advantages that enabled them to defeat traditional Asian armies. VOC military success was also enabled by their superior logistics and supply systems that could maintain military operations across vast distances for extended periods. The company's global trading networks provided supply chains that could deliver weapons, ammunition, food, medical supplies, and reinforcements to military forces operating anywhere in their territories. Their control over strategic ports and harbors enabled them to project naval power throughout the Indian Ocean and Southeast Asian waters, providing mobile fire support for land operations and preventing enemy forces from receiving external assistance. Their financial resources enabled them to maintain military operations during extended campaigns without the fiscal constraints that limited most governmental military forces. Most importantly, their corporate structure enabled them to coordinate military and commercial strategies in ways that made military conquest financially self-sustaining. Military operations that conquered new territories generated commercial opportunities that provided revenues to fund further military expansion. Commercial profits from controlled territories provided resources for military forces that protected and expanded corporate control. This integration of military conquest and commercial exploitation created positive feedback loops that enabled continuous expansion as long as new territories could be identified and conquered profitably. The VOC's first major military campaign demonstrated how corporate military power could achieve results that purely commercial negotiations had failed to accomplish. The Portuguese had controlled the crucial port of Malacca since 1511, using it as the center of their Asian trading empire and blocking Dutch access to the most profitable trade routes between India and China. Diplomatic negotiations and commercial competition had failed to break Portuguese control or gain Dutch access to Malacca's strategic position. In 1640-1641, the VOC launched a coordinated military campaign that combined naval blockade, artillery bombardment, and infantry assault with local political alliances that isolated Portuguese forces and prevented them from receiving reinforcements. The siege lasted 7 months and required enormous military expenditures, but its success provided the VOC with control over the strategic center of Asian trade and access to commercial opportunities that generated profits far exceeding the military costs. The Malacca conquest became a template for VOC expansion throughout Southeast Asia. Identify strategically important locations controlled by competitors, build local political alliances that isolated enemy forces, then use superior military technology and resources to achieve decisive military victory that provided access to profitable commercial opportunities. This template was applied successfully throughout the Indonesian archipelago, where the VOC systematically conquered or subordinated local kingdoms that controlled valuable spice-producing islands. In the Banda Islands, military conquest enabled the VOC to eliminate indigenous political structures and replace them with corporate plantation systems that maximized nutmeg production for export to European markets. In the Moluccas, military operations eliminated Portuguese and Spanish influence, while establishing exclusive VOC control over clove cultivation and trade. In Java, military intervention in succession disputes enabled the VOC to expand their territorial control while maintaining profitable relationships with compliant local rulers. But the VOC's military operations weren't limited to territorial conquest. They also used military force to eliminate commercial competitors and enforce market control in regions where they lacked direct territorial authority. English and Portuguese traders attempting to access spice markets in VOC-controlled territories were systematically attacked and expelled through military operations that treated commercial competition as acts of war. Asian merchants who attempted to trade with VOC competitors or circumvent company monopolies faced military retaliation that could destroy their commercial operations and threaten their personal safety. Local populations who resisted VOC economic control or attempted to maintain traditional trading relationships faced military suppression that could include destruction of villages, seizure of property, and enslavement of resistant communities. The VOC's military power also enabled them to intervene in Asian political conflicts in ways that served their commercial interests while expanding their territorial control and political influence. In Ceylon, they provided military support for local rulers who granted favorable trading concessions while using military force to eliminate rulers who attempted to maintain independence or establish relationships with competitors. In India, they intervened in succession disputes and regional conflicts to establish client relationships with rulers who needed VOC military support to maintain their political positions. Throughout Southeast Asia, they exploited existing political divisions and conflicts to expand their influence and control, while preventing the emergence of strong, unified opposition to Dutch domination. But the VOC's use of military force went far beyond what would be considered legitimate commercial security or reasonable competitive practices. They regularly used torture, mass executions, and collective punishment to terrorize populations that resisted their authority or attempted to maintain economic independence. They destroyed traditional political institutions and cultural practices that might provide organizational frameworks for resistance to corporate control. They implemented forced labor systems and tribute extraction that reduced local populations to conditions of economic slavery designed to maximize corporate profits. These military operations were financed by shareholder capital and conducted according to corporate strategic objectives rather than any governmental authority or international legal framework. VOC shareholders received dividend payments generated through military conquest and violent exploitation without meaningful oversight or accountability for the human costs of corporate military operations. The company's board of directors made strategic decisions about military campaigns based on profit projections and competitive considerations rather than ethical or humanitarian concerns. Regional military commanders operated with substantial autonomy to use whatever methods they considered necessary to achieve corporate objectives, leading to military operations that violated even the limited humanitarian norms of their historical period. This separation between financial benefits and moral responsibility for violence became a characteristic feature of corporate militarism that would influence colonial expansion and international business for the next 3 centuries. The Dutch government occasionally expressed concerns about VOC military operations that created diplomatic complications or threatened broader Dutch national interests, but they generally supported company military expansion as beneficial to Dutch economic and political influence. The VOC's military success demonstrated that corporate organizations could achieve political and military objectives that exceeded the capabilities of many national governments, but it also established precedents for private violence and economic exploitation that challenged traditional concepts of sovereignty and legitimate authority. Modern international law and business regulation specifically prohibit the kind of private military operations that the VOC conducted routinely, but multinational corporations continue to exercise economic and political influence that can affect the welfare and security of millions of people without meaningful democratic accountability. Understanding how the VOC built and used corporate military power provides insights into contemporary debates about corporate responsibility, international law, and the regulation of multinational business enterprises in regions where governmental authority is weak or conflicted. But the VOC's military and commercial success also enabled them to develop sophisticated techniques for manipulating financial markets and creating speculative bubbles that would become templates for financial engineering and market manipulation that continue affecting global capitalism today. Chapter 7. Market Manipulation. The VOC didn't just create the world's first stock market. They pioneered every technique of financial manipulation and market control that modern regulators spend billions trying to prevent. By the 1630s, the Amsterdam Stock Exchange had evolved far beyond simple trading in VOC shares. It had become a sophisticated financial marketplace where investors used complex strategies to profit from price movements regardless of underlying business fundamentals. The VOC's management understood that controlling their stock price was as important as managing their actual business operations. Share price affected their ability to raise capital, their cost of borrowing, and their capacity to use stock as currency for acquisitions and expansion. But they also realized that their privileged access to information about company operations and future plans gave them enormous advantages over ordinary investors that could be exploited for personal enrichment. VOC directors routinely used inside information about pending expeditions, territorial conquests, and commercial developments to trade in company shares before public announcements affected market prices. When the company planned military campaigns that would likely succeed in conquering profitable territories, directors and senior managers purchased shares in advance of public announcements about successful operations. When they anticipated problems with specific expeditions or territorial operations, company insiders sold shares before negative news became public and affected market prices. When they planned to manipulate supply levels of specific commodities to affect European market prices, they positioned their personal portfolios to benefit from the predictable price movements their corporate decisions would create. These practices weren't considered illegal or unethical, according to 17th century standards, but they created systematic advantages for corporate insiders that enabled them to extract wealth from ordinary shareholders through superior access to market-moving information. But insider trading was only the beginning of VOC financial manipulation. The company actively managed market perceptions of their business prospects through information campaigns that presented their operations in ways designed to support favorable stock price movements. They controlled the timing and content of information releases about expedition results, territorial acquisitions, and profit projections to maximize positive market reactions and minimize negative responses to disappointing developments. They provided selective access to company information for preferred investors and market analysts while restricting information availability for smaller shareholders and potential competitors. They coordinated with friendly financial institutions and investment partnerships to create coordinated buying or selling pressure that could move stock prices in directions that served company strategic objectives. Most importantly, they used their control over commodity supplies and market access to create artificial business conditions that supported their desired stock price movements. When the company wanted to demonstrate strong business growth to support rising stock prices, they could manipulate commodity supplies to create artificial scarcity that generated exceptional profit margins during specific reporting periods. When they wanted to discourage potential competitors or acquisition targets, they could flood markets with specific commodities to demonstrate their market control while making competitive operations appear unprofitable. When they needed to justify requests for additional capital or governmental support, they could create artificial crisis conditions that demonstrated the importance of company operations for Dutch economic and political interests. These market manipulation techniques were facilitated by the VOC's monopoly control over information about Asian economic and political conditions. European investors had no independent sources of reliable information about Asian markets, political developments, or competitive conditions that might affect VOC business prospects. The company's regular reports to shareholders were the primary source of information about Asian economic conditions for European financial markets, enabling them to frame market perceptions according to their strategic objectives rather than objective business analysis. Alternative information sources were limited to reports from competing European companies that had their own incentives to distort information about Asian conditions, or occasional diplomatic or missionary reports that lacked commercial expertise and market understanding. This information monopoly enabled the VOC to create and sustain market perceptions that served their financial objectives regardless of objective business fundamentals. But the company's market manipulation capabilities were amplified by their relationships with other financial institutions and investment partnerships that shared their interests in maintaining favorable market conditions. Dutch banks that provided loans secured by VOC shares had strong incentives to support company stock prices and avoid actions that might threaten the value of their collateral. Insurance companies that provided policies protecting VOC operations and investments shared interests in presenting company risks as manageable and business prospects as favorable. Investment partnerships that specialized in VOC-related trading strategies coordinated their activities with company objectives to create market conditions that benefited all participants in the informal network of VOC-related financial institutions. These relationships created what modern financial economists would recognize as systematic market manipulation that involved coordination between multiple institutions to control prices and trading patterns for mutual benefit. The most sophisticated example of VOC market manipulation involved their management of the tulip bubble that reached its peak in 1636-1637. While tulip trading involved separate markets and different commodities from traditional VOC business, many of the same financial institutions and wealthy individuals participated in both markets using similar speculative techniques and market manipulation strategies. VOC-related financial networks provided models and techniques for creating artificial scarcity, managing information flows, and coordinating trading strategies that were applied to tulip markets with spectacular short-term success and devastating long-term consequences. The company's international networks enabled them to import tulip bulbs from Asia and manipulate supply levels to support speculative price increases that attracted increasing numbers of investors seeking extraordinary returns. Their financial expertise enabled them to develop complex derivative instruments that allowed investors to speculate on tulip price movements without owning actual bulbs, increasing market activity while disconnecting prices from physical supply and demand fundamentals. Their market-making capabilities enabled them to provide liquidity and price support that created appearances of stable and growing markets even when underlying demand was insufficient to justify prevailing price levels. But when the tulip bubble collapsed in February 1637, the resulting financial crisis threatened the entire Dutch financial system and demonstrated the dangerous instability that sophisticated market manipulation could create. Thousands of investors lost their life savings when tulip prices collapsed from extraordinary highs to nearly worthless levels within weeks. Financial institutions that had provided credit secured by tulip contracts faced massive losses that threatened their solvency. The broader Dutch economy experienced economic disruption as consumer spending declined and business confidence collapsed in response to widespread financial losses and institutional instability. The VOC's involvement in tulip speculation and market manipulation contributed to broader public skepticism about financial innovation and speculative investment that temporarily reduced demand for company shares and other corporate securities. But rather than learning from the tulip bubble's lessons about the dangers of excessive speculation and market manipulation, the VOC intensified their efforts to control financial markets and extract value from their privileged market position. They used their recovery from tulip-related losses to demonstrate their superior financial management and business resilience compared to smaller competitors who had been eliminated by the financial crisis. They expanded their financial services operations to provide banking, insurance, and investment management services for wealthy individuals and institutions that had lost confidence in alternative financial service providers. They leveraged their enhanced market position to negotiate more favorable terms with suppliers, customers, and government authorities who had become more dependent on VOC financial stability and commercial relationships. Most importantly, they continued developing more sophisticated techniques for managing market perceptions and controlling stock prices that would enable them to maintain their dominant position despite growing competition and changing economic conditions. These techniques included early versions of what modern finance recognizes as earnings management, where companies use accounting flexibility to smooth reported profits and manage market expectations about business performance. The VOC developed accounting practices that allowed them to defer recognition of losses from failed expeditions while accelerating recognition of profits from successful operations, creating reporting patterns that suggested more consistent business performance than their actual operations achieved. They used reserve funds and contingency accounting to manage the timing of expense and revenue recognition in ways that supported desired stock price movements and market perceptions. They developed complex transfer pricing and profit allocation systems that enabled them to report higher profits in periods when they needed market support while building reserves that could absorb losses during less favorable market conditions. These practices enabled the VOC to maintain investor confidence and stock price stability, despite the inherent volatility and uncertainty of their international business operations. But they also created systematic distortions in financial reporting and market information that prevented investors from making informed assessments of company risks and business prospects. The precedents that the VOC established for market manipulation and financial engineering became templates for corporate financial management that continue affecting modern capitalism and financial regulation. Contemporary debates about insider trading, market manipulation, and financial reporting standards reflect ongoing tensions between corporate interests in managing market perceptions and investor interests in accurate information about business fundamentals. Understanding how the VOC pioneered financial manipulation techniques provides insights into the historical development of financial markets and regulatory frameworks that remain relevant for contemporary policy discussions about corporate accountability and market integrity. But the VOC's financial engineering was only possible because they had achieved unprecedented economic power and political influence that enabled them to operate with minimal oversight or accountability from governmental or market institutions. The next chapter examines how they reached the peak of their global dominance when they controlled more economic power than most national governments and exercised influence over international politics that exceeded many sovereign nations. Chapter 8. Peak Power. In 1669, the Dutch East India Company reached the absolute pinnacle of corporate power in human history. They controlled more wealth than most European nations, exercised sovereign authority over territories larger than modern Germany, and influenced global politics in ways that no private corporation has achieved before or since. The numbers from this peak period are staggering by any historical or contemporary standard. The VOC's annual revenues exceeded 50 million guilders, equivalent to approximately $8 billion in today's purchasing power. For comparison, the annual budget of the French government was about 40 million guilders, while England's government revenues were approximately 35 million guilders. A private corporation was generating more income than the two largest European powers. Their territorial control extended over approximately 2 million square miles across Asia, including substantial portions of present-day Indonesia, Malaysia, Sri Lanka, India, Taiwan, and various trading enclaves throughout the Indian Ocean and Southeast Asia. They employed over 150,000 people directly, with millions more dependent on VOC-controlled economic activities for their livelihoods. Their fleet included over 1,500 vessels, ranging from massive ocean-going ships to local trading craft and military vessels. But the VOC's real power wasn't measured in revenues or territorial control. It was their ability to influence international politics and economic conditions throughout the world. European governments consulted VOC directors before making major policy decisions about Asian affairs because company intelligence networks provided the most reliable information available about political and economic conditions throughout Asia. Asian rulers negotiated with VOC representatives as equals or superiors because company military and economic resources often exceeded those of local governments. International commodity prices for spices, silk, tea, precious metals, and other valuable goods were largely determined by VOC supply decisions rather than market forces. Global shipping routes and commercial infrastructure in the Indian Ocean and Southeast Asia operated according to VOC strategic objectives rather than neutral commercial principles. The company had achieved something unprecedented. They had become a parallel world system that operated according to corporate objectives rather than governmental authority or market mechanisms. At their Amsterdam headquarters, the Heren 17th Council of 17 made decisions that affected the welfare and security of millions of people across 4 continents. They could declare war, negotiate peace treaties, impose taxes, and administer justice without meaningful oversight from any governmental authority. Their decisions about commodity production and trade could create prosperity or famine in regions across Asia. Their military operations could determine which local rulers maintained power and which were eliminated. Their commercial policies could integrate regions into global markets or isolate them from international economic opportunities. This concentration of private power created a situation that challenged traditional concepts of sovereignty and legitimate authority. The VOC operated according to corporate law and shareholder interests rather than governmental accountability or democratic representation. Their decisions were made to maximize profits and market dominance rather than serve broader public welfare or international stability. Yet their economic and military capabilities enabled them to exercise governmental functions and international influence that affected political and economic conditions worldwide. The Dutch government had created an autonomous corporate entity that pursued its own interests, while operating under Dutch legal authority and claiming Dutch governmental protection for its international activities. This arrangement served Dutch national interests during the VOC's period of rapid expansion and commercial success, but it also created potential conflicts between corporate objectives and broader Dutch diplomatic and political considerations. The VOC's quasi-sovereign status became particularly problematic during conflicts with other European powers, where company actions could trigger broader international wars that served corporate interests while threatening Dutch national security. The Second Anglo-Dutch War, 1665-1667, was largely caused by commercial conflicts between the VOC and English trading companies, but it required enormous expenditures of Dutch governmental resources to defend VOC interests against English military retaliation. The War of Spanish Succession, 1701-1714, involved complex interactions between VOC commercial objectives and broader European political conflicts that forced the Dutch government to coordinate military and diplomatic strategies with corporate interests that didn't always align with national priorities. These conflicts demonstrated the dangers of allowing private corporations to exercise quasi-sovereign authority in ways that could trigger international conflicts, requiring governmental, military, and financial resources to resolve. But during the VOC's peak period in the 1660s and 1670s, these potential problems seemed manageable compared to the enormous economic and political benefits that corporate success was providing for Dutch prosperity and international influence. The Netherlands had become the wealthiest and most commercially advanced nation in Europe, largely through VOC profits and the secondary economic activities that company success had generated. Amsterdam had emerged as the financial center of Europe, with capital markets and banking institutions that attracted investment and commercial activity from throughout the continent. Dutch shipbuilding, manufacturing, and service industries had developed capabilities that served markets throughout Europe, while building on expertise and demand generated by VOC operations. Dutch political influence in European affairs had expanded substantially due to the economic resources and international connections that VOC success had created. The company's global operations had generated enormous wealth for thousands of Dutch investors, while creating employment opportunities and commercial relationships that supported broader Dutch economic development. But the VOC's peak period also revealed fundamental contradictions in their business model that would eventually undermine their long-term sustainability and competitive advantage. Their monopolistic control over Asian trade required constant military expenditures and territorial expansion that consumed increasing portions of their revenues, while creating political opposition and competitive responses that threatened their market dominance. Their extraction of wealth from Asian territories had reached levels that were generating resistance movements, competitive responses, and economic disruptions that reduced the long-term productivity and stability of their controlled regions. Their financial manipulation and market control had created speculative distortions and investor expectations that were becoming difficult to sustain as competitive pressures increased and profitable expansion opportunities became more limited. Most importantly, their success had attracted competitors who were copying their business methods while avoiding some of the costs and inefficiencies that the VOC's monopolistic practices had created. The English East India Company was expanding its operations throughout Asia, using strategies that emphasized commercial competition rather than territorial conquest, enabling them to serve Asian markets more efficiently while avoiding the military expenditures that consumed substantial VOC revenues. French colonial enterprises were establishing alternative trade routes and supply sources that challenged VOC monopolies while providing Asian producers with competitive alternatives that reduced their dependence on Dutch commercial relationships. Private traders and smaller commercial enterprises were finding ways to circumvent VOC control and access Asian markets through routes and methods that the company couldn't monitor or prevent effectively. These competitive pressures were compounded by technological and economic changes that were reducing the advantages that had enabled VOC dominance during their early expansion period. Improvements in navigation, shipbuilding, and communication were making long-distance trade more accessible to smaller competitors while reducing the scale advantages that had made VOC operations more efficient than alternative approaches. European demand for traditional Asian luxury goods was evolving in ways that reduced the profitability of spice trading while creating opportunities for competitors who could provide new products and services that better served changing consumer preferences. Asian economic and political development was creating more sophisticated local institutions and commercial networks that could provide alternative approaches to international trade that didn't require European intermediaries or colonial control. But rather than adapting their business model to address these changing competitive and economic conditions, The VOC attempted to maintain their peak period dominance through intensified application of the strategies that had originally enabled their success. They increased their military expenditures and expanded their territorial control to prevent competitors from accessing alternative supply sources and commercial opportunities. They intensified their monopolistic practices and market manipulation to maintain profit margins and stock price performance, despite declining operational efficiency and increasing competitive pressure. They expanded their extractive practices in controlled territories to generate the revenues needed to fund their expensive defensive strategies against competitive challenges. These responses to competitive pressure generated substantial short-term profits and maintained the company's dominant market position, but they also intensified the fundamental contradictions that would eventually destroy the VOC's competitive advantages and financial viability. The peak period of VOC power represents both the greatest achievement of early corporate capitalism and a demonstration of the ultimately unsustainable character of business models based on monopolistic control and extractive exploitation. Understanding how the VOC achieved unprecedented corporate power while simultaneously creating the conditions for their eventual decline provides crucial insights into the possibilities and limitations of private economic power that remain relevant for contemporary debates about corporate responsibility and democratic governance. The next phase of their story involves examining how internal corruption, competitive pressure, and changing economic conditions combined to destroy the most powerful corporation in history and end 2 centuries of Dutch commercial dominance. Chapter 9: Corporate Collapse. The collapse of the VOC wasn't sudden. It was a slow-motion corporate death that took over a century, caused by the same monopolistic practices and extractive strategies that had originally made them the most powerful company in history. By 1700, the warning signs were unmistakable for anyone willing to see them. The company's military expenditures had grown to consume over 80% of their revenues, creating a vicious cycle where territorial expansion required military costs that required more territorial expansion to fund. They were spending more money conquering and controlling territories than those territories generated in profits. Their debt had grown to over 85 million guilders, more than the combined annual revenues of most European governments. Interest payments alone consumed nearly half of their commercial profits, forcing them to extract ever-increasing tribute from colonized territories to maintain basic operations. Competition from English, French, and private traders was systematically undermining their monopolies and reducing their profit margins on traditional products. Alternative supply sources and trade routes were making VOC control over spice markets economically irrelevant. But perhaps most damaging was the institutional corruption that had infected every level of corporate operations, from Amsterdam headquarters to remote trading posts throughout Asia. The VOC's problem wasn't just individual managers stealing money, though that was endemic. The problem was systematic corruption that had transformed the company from a profit-generating enterprise into a rent-seeking machine designed to extract wealth from controlled territories while enriching corporate insiders at shareholder expense. This corruption was built into the company's organizational structure and incentive systems in ways that made it extremely difficult to detect or prevent. VOC employees throughout Asia received salaries that were below subsistence levels for European standards of living, creating systematic incentives for supplementary income through private trading, tribute collection, and various forms of theft from company operations. Regional managers operated with minimal oversight from Amsterdam headquarters due to communication delays and distance, enabling them to develop independent revenue sources and business relationships that served their private interests rather than corporate objectives. The company's monopolistic control over information about Asian conditions enabled local administrators to misrepresent their activities and financial performance to central management while pursuing strategies that maximize their personal enrichment rather than corporate profits. Most importantly, the integration of commercial and governmental authority enabled VOC officials to use their political power to create business opportunities and eliminate competitive threats that served their private interests while appearing to serve legitimate corporate objectives. Colonial administrators could grant exclusive trading licenses to businesses they secretly owned or controlled. They could impose taxes and tributes that were partially diverted to private accounts. They could use company military forces to eliminate competitors or enforce business arrangements that generated private profits. These activities were extremely difficult for Amsterdam management to monitor or prevent because they appeared to be legitimate exercises of governmental authority and commercial management that the company's charter explicitly authorized. The result was a systematic transformation of VOC operations from productive commercial enterprise into extractive exploitation that destroyed the economic foundations that had originally supported corporate profitability. Asian territories under VOC control experienced declining agricultural productivity, reduced manufacturing output, and deteriorating commercial infrastructure as company officials prioritized short-term extraction over long-term economic development. Local populations had reduced incentives to increase production or improve quality, when most of the resulting profits would be extracted through company taxation, tribute requirements, or forced sales at below-market prices. Traditional political and economic institutions that had supported productive economic activity were systematically weakened or eliminated to facilitate corporate control, but they weren't replaced with alternative institutions that could maintain economic productivity under colonial administration. The cumulative effect was economic decline in most VOC-controlled territories that reduced their capacity to generate the profits needed to support company operations while increasing the military expenditures required to suppress resistance and maintain control. This economic decline was accelerated by competitive pressure from other European companies that offered better terms for Asian producers while providing more efficient access to European markets. The English East India Company was developing commercial relationships throughout Asia that emphasized mutual benefit and sustainable economic development rather than extractive exploitation. They could offer higher prices for Asian goods, better access to European markets, and more favorable terms for commercial relationships because they didn't need to fund extensive territorial administration and military control. French commercial enterprises were establishing alternative trade routes and supply sources that provided Asian producers with competitive options that reduced their dependence on VOC commercial relationships. Private traders were finding ways to access Asian markets through routes and methods that circumvented VOC control while providing better returns for both Asian suppliers and European consumers. This competitive pressure created a feedback loop that accelerated VOC decline. As their commercial relationships became less profitable and attractive to Asian partners, the company responded by intensifying their use of political control and military force to maintain market access and profit margins. But increased reliance on coercion and extraction further reduced the attractiveness of VOC relationships, while increasing the military and administrative costs required to maintain their operations. Meanwhile, competitive alternatives became more attractive to Asian producers and European consumers, creating market conditions that made VOC monopolistic practices economically unsustainable, even when they could still be enforced militarily. The financial crisis that ultimately destroyed the VOC was triggered by the Fourth Anglo-Dutch War, 1780-1784, but the underlying causes were the institutional and strategic problems that had been accumulating for decades. The war disrupted VOC shipping and trading operations while requiring enormous military expenditures that the company could no longer afford without additional borrowing that creditors were increasingly unwilling to provide. VOC stock prices collapsed as investors realized that the company's debt levels and operational challenges made future profitability extremely unlikely. The collapse in stock prices made it impossible for the company to raise additional capital through equity financing. Territorial rebellions throughout Asia took advantage of the company's military and financial weakness to challenge Dutch control and establish relationships with alternative European traders or independent commercial networks. The Dutch government, facing its own financial crisis from the war, was unable to provide the military and financial support that the VOC needed to maintain their territorial control and commercial operations. By 1795, the VOC was technically bankrupt, with debts that exceeded the value of all their assets, and an ongoing cash flow crisis that made it impossible to fund basic operations. The company was formally dissolved in 1799, with its territories and assets transferred to the Dutch government, which lacked the resources to maintain effective control over most former VOC possessions. The collapse of the VOC represented more than just the failure of a single corporation. It marked the end of an era when private companies could exercise quasi-sovereign authority and control substantial portions of the global economy through monopolistic practices and military force. The institutional innovations that the VOC had pioneered, joint stock corporate organization, public stock markets, global business coordination, survived and became foundational elements of modern capitalism. But the specific business model that had enabled their unprecedented success, monopolistic control over essential commodities through territorial conquest and extractive exploitation, proved unsustainable when confronted with competitive pressure, institutional corruption, and the inherent contradictions of extractive economic relationships. The VOC's collapse demonstrated that even the most powerful and innovative corporations are vulnerable to institutional decay and strategic obsolescence when they fail to adapt to changing competitive and technological conditions. Their experience provides important lessons for understanding both the possibilities and limitations of corporate power that remain relevant for contemporary debates about multinational corporate responsibility and democratic governance. But perhaps most importantly, the VOC's rise and fall illustrates how corporate innovations that enable productive economic development can evolve into extractive systems that undermine their own foundations while creating social and economic problems that persist long after the original corporate entities have disappeared. Understanding how the most successful corporation in history ultimately destroyed itself through corruption and strategic inflexibility provides crucial insights into the ongoing challenges of balancing corporate freedom with social responsibility in modern market economies. The final chapter examines how the VOC's innovations became the foundations for modern capitalism, while their failures provided warnings about corporate power that contemporary societies are still struggling to address. Chapter 10. Modern Legacy. Walk into any modern corporation, open a stock trading app, or examine the structure of today's global economy, and you're seeing the world that the VOC created 400 years ago. Every fundamental feature of contemporary capitalism can be traced directly to innovations that the Dutch East India Company pioneered. Publicly traded corporate shares, limited liability for investors, professional management separated from ownership, multinational business operations, global supply chains and stock markets that enable investment across geographic and temporal boundaries. But the VOC's legacy extends far beyond business organization and financial mechanisms. They established patterns of corporate behavior, government-business relationships, and global economic integration that continue shaping how modern capitalism operates and how societies attempt to regulate corporate power. Understanding this legacy requires examining both the productive innovations that enabled unprecedented economic development and the destructive practices that demonstrated the need for democratic oversight and regulatory constraints on corporate power. The most obvious direct descendants of VOC innovations are the organizational structures and financial instruments that enable modern multinational corporations to coordinate activities across global markets while accessing capital from investors worldwide. Amazon, Google, Apple, and other contemporary corporate giants operate according to legal and organizational principles that the VOC established. They are permanent corporate entities that survive beyond individual founders. They raise capital through public stock offerings that enable diverse investors to own shares in future profits. They coordinate activities across multiple countries through professional management hierarchies, and they use their stock as currency for acquisitions and strategic partnerships. But modern corporations also face regulatory constraints and competitive conditions that the VOC never encountered. Contemporary antitrust law specifically prohibits the kind of monopolistic practices that enabled VOC dominance over Asian trade. Modern corporations cannot eliminate competitors through military force, impose exclusive trading relationships through territorial conquest, or manipulate markets through supply control and information monopolies that the VOC used routinely. Labor law, environmental regulation, and human rights oversight create legal obligations and public accountability mechanisms that limit corporate freedom to pursue profit maximization regardless of social and environmental costs. International law and multilateral institutions provide frameworks for regulating multinational corporate behavior that didn't exist during the VOC's period of operation. These regulatory differences reflect lessons learned from the VOC experience and subsequent corporate abuse that democratic societies have attempted to address through legal and institutional constraints on corporate power. But many of the fundamental tensions between corporate objectives and broader social welfare that emerged during the VOC's operations persist in contemporary debates about corporate responsibility and democratic governance. Modern multinational corporations continue to face incentives for short-term profit maximization that can conflict with long-term sustainable development and social responsibility. Shareholder pressure for quarterly earnings growth and stock price appreciation creates similar pressures for corporate managers that VOC directors experienced from dividend expectations and share price performance. Contemporary global supply chains continue to involve economic relationships between wealthy developed countries and poorer developing regions that can replicate some of the extractive patterns that characterized VOC colonial operations, though within legal frameworks that provide more protections for workers and communities. Modern financial markets continue to enable speculative activity and market manipulation that can create bubbles and systemic risks similar to those that the VOC helped pioneer during the Dutch financial crises of the 17th century. The VOC's integration of commercial and political authority also established precedents for corporate political influence that continue affecting contemporary democratic governance. While modern corporations cannot exercise direct governmental authority over territories and populations, they do exercise substantial indirect influence over government policies through lobbying, campaign contributions, regulatory capture, and the economic leverage that comes from controlling employment and investment opportunities. Large multinational corporations can threaten to relocate operations or investment to jurisdictions with more favorable regulatory environments, creating competitive pressure between governments that can undermine democratic accountability and social protection policies. Corporate influence over trade policy, tax policy, and regulatory frameworks can serve corporate interests while imposing costs on workers, communities, and environmental quality that don't appear in corporate financial statements. These contemporary forms of corporate political influence are more constrained and accountable than the quasi-sovereign authority that the VOC exercised, but they raise similar questions about the compatibility between concentrated corporate power and democratic governance. The VOC experience also provides insights into the relationship between corporate innovation and economic development that remain relevant for contemporary policy debates about globalization and international trade. The company's innovations in business organization, financial markets, and international coordination enabled unprecedented economic growth and cultural exchange that benefited millions of people throughout Europe and Asia. Their commercial networks facilitated technological transfer, cultural exchange, and economic specialization that wouldn't have been possible under alternative organizational arrangements. But these benefits came with enormous human costs through colonial exploitation, environmental destruction, and economic disruption that persisted long after the company's collapse and continued affecting the societies they had dominated. Contemporary multinational corporations create similar combinations of economic benefits and social costs that require careful analysis and policy responses that can preserve the productive capabilities while minimizing the destructive consequences. Modern global supply chains enable consumers worldwide to access goods and services at lower costs while creating employment and development opportunities in developing countries. But they also create environmental pressures, labor exploitation, and economic dependencies that can replicate some of the problems that VOC operations created in Asian societies. International trade and investment can facilitate technology transfer and economic development, while also creating competitive pressures and economic disruptions that can undermine local industries and communities if not properly managed through appropriate policies and institutions. The VOC's experience suggests that realizing the benefits of global economic integration while minimizing its costs requires active democratic governance and international coordination rather than relying solely on market mechanisms and corporate self-regulation. Perhaps most importantly, the VOC's story demonstrates both the enormous potential of corporate innovation to solve complex economic and social problems and the serious dangers of allowing corporate power to operate without adequate democratic oversight and accountability. The same organizational capabilities that enabled the VOC to coordinate beneficial economic development across continents also enabled them to organize violence and exploitation on unprecedented scales. The same financial innovations that made modern capitalism possible also created opportunities for speculation and manipulation that threatened economic stability. Contemporary societies face similar challenges in ensuring that corporate innovation serves broad social interests rather than just private enrichment. This requires regulatory frameworks, democratic institutions, and international cooperation that can harness corporate capabilities for beneficial purposes while preventing their use for harmful activities. The VOC pioneered corporate social responsibility practices, including employee welfare programs, infrastructure development, and educational institutions in their territories. But these beneficial activities were secondary to profit maximization objectives and were discontinued when they conflicted with financial pressures. Modern corporations face similar tensions between social responsibility and profit maximization that require external institutional frameworks to ensure that beneficial activities are sustained rather than abandoned when financial conditions change. Understanding the VOC legacy also provides perspectives on contemporary debates about corporate size, market concentration, and the regulation of technology companies that have achieved global influence comparable to historical trading companies. Amazon, Google, Facebook, and other technology giants operate with global reach and economic influence that echoes the VOC's dominance during their peak period. They control essential infrastructure for modern economic activity, influence information flows and market access for millions of businesses, and exercise substantial influence over government policies and social developments. But unlike the VOC, modern technology companies operate within democratic societies with established institutions for corporate oversight and accountability. The challenge is ensuring that these institutions can adapt to address the new forms of corporate power that technological innovation has created. The VOC's experience suggests that corporate power becomes problematic when it lacks competitive constraints and democratic accountability, rather than when it achieves large-scale or global reach. The solution isn't necessarily breaking up large corporations, but ensuring that they operate within institutional frameworks that align corporate incentives with broader social welfare. This requires ongoing adaptation of legal, regulatory, and international frameworks that can address new forms of corporate power while preserving the innovative capabilities that enable corporations to contribute to economic development and social problem-solving. The VOC created modern capitalism, but they also demonstrated why capitalism requires democratic governance and regulatory oversight to serve human welfare rather than just private enrichment. Their legacy continues shaping contemporary debates about how to balance corporate freedom with social responsibility in an increasingly complex and interconnected global economy. So we've witnessed the rise and fall of the most powerful corporation in human history, a company that literally created the economic system that rules our world today, while simultaneously demonstrating why that system requires constant vigilance to prevent it from consuming the societies it's supposed to serve. The Dutch East India Company achieved something unprecedented in human history. They solved the fundamental problems of early capitalism and created organizational structures that enabled economic coordination and wealth creation on a scale that was previously impossible. Their innovations in corporate finance, business organization, and global coordination became the foundations for every major corporation that followed. Microsoft, Amazon, Tesla, Google, they all use legal structures, financial instruments, and operational methods that the VOC pioneered 400 years ago. The stock market where you invest your retirement savings, created by the VOC. The multinational corporations where millions of people work, based on the VOC business model. The global supply chains that bring products to your door, built on infrastructure and techniques that the VOC developed. But their story also reveals the fundamental tensions within capitalist organization that continue challenging democratic societies today. The same corporate structures that enabled unprecedented economic development also enabled unprecedented exploitation and violence. The same financial innovations that created modern capitalism also created opportunities for speculation and manipulation that threaten economic stability. The same organizational capabilities that generated enormous prosperity for investors also concentrated power in ways that challenged democratic accountability. The VOC's 200-year domination of global trade demonstrates both the enormous potential of private enterprise to create wealth and solve complex problems, and the serious dangers of allowing private power to operate without adequate oversight and constraints. When the company was focused on productive activities, developing new trade routes, improving transportation and communication, creating financial instruments that enabled international commerce, they generated enormous benefits for people throughout Europe and Asia, while earning spectacular returns for their shareholders. But when they used their accumulated power to establish monopolistic control and extract wealth through violence and coercion, they created economic and social problems that persisted long after their collapse, while ultimately undermining their own competitive position. The lesson isn't that corporations are inherently good or evil. It's that corporate power, like any form of concentrated power, can serve beneficial or harmful purposes depending on the institutional frameworks and incentive structures within which it operates. The VOC succeeded as long as their corporate objectives aligned with productive economic development that served broader social interests. They failed when their monopolistic practices and extractive strategies conflicted with competitive efficiency and social welfare. Understanding this distinction is crucial for contemporary debates about corporate responsibility and regulation. Modern multinational corporations operate with economic influence that approaches the VOC's historical dominance. Technology companies control information flows and market access for billions of people. Financial institutions influence economic conditions worldwide. Manufacturing corporations shape labor and environmental conditions throughout global supply chains. These corporations have capabilities to contribute enormously to solving contemporary challenges like climate change, global poverty, and technological development that could benefit humanity for generations. But they also have capabilities to concentrate wealth and power in ways that undermine democratic governance and social welfare if they're allowed to operate without adequate oversight and accountability. The VOC experience suggests that the challenge isn't eliminating corporate power or preventing business innovation. It's ensuring that corporate capabilities are directed toward productive purposes that serve broader human welfare rather than just private enrichment. This requires active democratic governance that can adapt regulatory frameworks and institutional structures to address new forms of corporate power, while preserving the innovative capabilities that enable corporations to contribute to economic development and social problem-solving. It requires international coordination that can address the global scope of modern corporate operations while respecting diverse national values and democratic processes. Most importantly, it requires public understanding of how corporate power operates and what institutional safeguards are necessary to ensure that private enterprise serves public interests rather than threatening democratic governance and social welfare. The VOC story provides both inspiration and warning for contemporary societies facing these challenges. Their innovations enabled unprecedented human prosperity and cultural